Welcome back to the Stepping Bricks YouTube channel. My name is Dr. Giuseppe Paladini, and today we're going to cover one very delicate topic, is tax. If you are investing in property, probably one of the most important things to consider is not much how much money you're going to make, but how much money you're going to keep. Because obviously with tax, you have to include as well these outgoings from your bank account to HMRC. So one of the things to consider when you plan for tax liability is how can you use the legal ways for minimizing your tax liabilities in property. There are several ways. My suggestion to you is, number one, speak to a proper accountant. I'm not an accountant, I have the knowledge, but I always refer you back to the accountant. The important thing about this video is you can have the right questions to ask your accountants. Remember, not all accountants are property specialists. Some of them are business specialists, but not necessarily know about property. And if they don't know much about properties, they probably don't know either how to save you money on that particular transaction. So let's give you an example. There are a few taxes for property investors. There's the stamp duty, which is called differently in different countries of the UK. So the stamp duty is a tax together with the additional dwelling supplement that are at the moment of buying a property. So there is stamp duty for when you buy your property, then the additional dwelling supplement is when you buy a second property. So different kinds of taxes, but you need to calculate the percentage based on where you buy the property. So your solicitor will collect this tax. There's nothing you can do about this tax unless there are particular circumstances which we're going to talk about. For example, if your property is unmortgageable, what does it mean unmortgageable? You cannot put a mortgage in because the lender will not consider it in a living state, which means, one of the examples is doesn't have a kitchen. So if the property is in rundown condition, doesn't have a kitchen or a bathroom, then there is no stamp duty. It's unmortgageable, so you can only buy for cash or by using bridging finance, okay? And then once you bring it back up to standards, then you can mortgage it, so refinance it. You can pull all your money out. You can either pull the money out from the cash you put in or repaying the bridging, and then you have a normal mortgage with a lower interest rate per month. And in that case, you don't pay stamp duty because a property was unmortgageable, didn't have a kitchen. Now, probably you will have to pay to begin with, and then you can claim it back. So there are tax specialists that can help you to claim this one back. Another tax is the capital gain tax, another tax in property. So capital gain tax, CGT, is a tax that is based on the difference between what you bought it for and what you sold it for. For example, if you buy a property for £100,000 and then you sell it for £200,000, there is £100,000 of difference, and there is a percentage of the amount that is taxable for capital gain tax. Now, a lot of people don't know what to do. Shall I sell the property? Shall I rent the property? What do I do? Most of the circumstances are the actual people are asking about the capital gain tax are people that are using that property as their main residential, okay? So their main residence is that property, and that tax is not applicable on your main residence. So if you are afraid of selling your property, the way you're living in, your main residence, to a higher price because the market has changed and the property increased in value, or you've done a lot of refurb, then don't worry about it because capital gain tax is not applicable to your main residence. For example, some people love this strategy, and what they do, they use a nomad behavior. For example, they buy a house that is run down, they move in, they do all the renovation, they stay, 1 year, and then they sell it and move out to the next one. In that case, they never pay the capital gain tax because it's always their main residence. When they buy the second property, they're going to sell the first one, so the second one becomes their main residence. And that's a way to do it. Now, I wouldn't like to live in a building site forever, because at some point you want your peace of mind, you want to stay relaxed in your house and not having all the dust and all the work. But for some people this won't work. I don't personally prefer this strategy, but for some people they make a lot of money by doing this 3, 4, 5 times. Another tax is the income tax. Income tax in property or in any kind of job is the tax you pay on the income you get every single year. Okay, you have a salary per month and you pay the income tax. You have a business, if it's your sole trader, you have income tax, your own name. But if it's in a limited company, you have a corporation tax, which is the same principle but uses different percentages. So when somebody wants to get in property and they ask me, shall I buy this property in a limited company or in my personal name? By the way, I have another video about this. The question I always ask is, what is your long-term strategy? Because if you're planning to buy 1, 2 properties, probably just buy in your personal name. There's not much difference in income tax. But if you're planning to scale up your business and have 10 properties, 20 properties, 30 properties, then I would say consider the incorporation of a limited company, and then you only pay, at the time of recording today is 19% corporation tax, okay? Compared to, if you're a high rate taxpayer, then you can probably pay 40-45% of the income tax. So you need to balance, you need to see your circumstances. If you're a low rate taxpayer, then it's 20-21%, so it doesn't make much difference with a limited company. But if you have already a job plus the rental income, you're going to pay a lot of money in tax. So to reduce your tax liability, I would consider incorporating a limited company and run your business through your limited company, pay corporation tax, which is 19%, and then you don't pay income tax because you already paid corporation tax. Again, please discuss with a proper accountant and a property accountant. They can let you understand a little bit more about the implications of using different tax advantages. Some of the taxes were in the past deductible. For example, your mortgage interest payments, where you were used to offset them against the income of the rental income. For example, you have £1,000 rental income, then you have £400 mortgage interest payment for that property. So your profit in this particular case was 600. However, with the introduction of Section 24, this one disappeared completely. So even if you have £1,000 income and £400 expenses for your mortgage, your tax liability would be for the full £1,000. So some of the taxes were really advantageous for people in their personal name, with properties in their personal name. However, this one has now changed and is not available anymore because of Section 24. However, if you are educated, if you are in a group, with like-minded people, you have a mentor, you have a supporting group, you are in an environment, you go to networking event, you educate yourself all the time, you will learn that this Section 24 is not applicable to limited companies, for example. So if you have a property in a limited company, you can still deduct your mortgage interest payment against your income. So this is still possible. If you have serviced accommodation, which is classified as commercial, you can still do the same things, because Section 24 doesn't apply on commercial, doesn't apply on serviced accommodation, doesn't apply on limited companies. So only applies on landlords that have properties on, in their own name. Again, this is one of the reasons why many people move their business into a limited company, and that's why they wanted to get a lot of tax advantages. Also, because of legacy, some people prefer the limited companies because they can pass on the income when they're not in this world anymore, because you can put shareholders in your limited company and they can keep the limited company without paying any inheritance tax at the end, because the company owns the property, is not you. So inheritance tax is another one, is a big one, and there are inheritance tax specialists that talk about this and how you can minimize your inheritance tax. Some of the company structures are not affected by inheritance tax, for example, limited liability partnership, an LLP. But again, I keep repeating this, I'm giving you the knowledge. Please go and check with your accountant your specific circumstances, because they might not be applicable to that specific case. And finally, another way to keep your money in the business is to take advantage of the capital allowances. Capital allowances, there are capital allowances specialists within the accountancy firms, and they can help you depending on the type of property, depending on the amount you spend, and depending on the refurb that is needed, depending on the machineries that you buy for your business, etc. Capital allowances, there are different capital allowances that you can claim back on the purchase price and on the refurb cost as well. You have two types of capital allowances for commercial properties. It's also applicable to residential, to serviced accommodation, sometimes to buy-to-let as well, but mainly the main tax advantage is on commercial properties. And there are two types of this. One is the capital allowances that you can claim before you purchase the property. So you need to understand if the property has ever been under capital allowance claiming. For example, if the previous owner already claimed capital allowances on that property, you cannot claim it anymore, because it's only once in the lifetime of that property. Sometimes it's about 30-40% of the purchase price, so it's quite important sum of money that you can claim back on the purchase price and on the refurb. So capital allowances, before you exchange contracts, your solicitor can send a letter to the other solicitor, the vendor solicitor. They can ask if they claimed capital allowances, and if not, then that means they give you the permission to do it for your own. Some people say, okay, but if I ask them if they claim capital allowances, am I not risking they're going to claim it right now? Well, yes and no, because it takes quite a long time, so they might not have time before they sell it to you. So, or some people don't even know what capital allowances is. So it's better to do it right, because if you don't send the letter before you complete, before you exchange contracts, you cannot claim it anymore. The second capital allowances is the one that is from the tenant point of view. So let's say you have a commercial property that you bought and you rent it out to a business. The business can claim capital allowances on plant and machinery. Okay, so anything they need to start up the business, they can claim capital allowances. So if, for example, you have a situation where you're buying a property, commercial, and then you rent it out to yourself, to your limited company as a business, then you have two types of capital allowances you can claim for two different businesses. Okay, you cannot mix them together. But in that case, it's one before the purchase, one after the purchase. Again, I hope these tips have been useful. There are so many other tax advantages. As I said before, we are not accountants, so please do seek professional advice, and they can help you massive times. So don't be afraid of asking the right question. Don't be afraid because you're not trying to avoid tax. Please do not do that, because it's illegal. You only try to take advantage of the benefits, tax benefits that are available for businesses to survive and thrive in any economy. My name is Dr. Giuseppe Palladini. I'm the founder of Stepping Bricks, and I'll see you in the next video. Bye bye.